Picture this. It's September 2008. The world's financial system is a house of cards, and one bank, Lehman Brothers, is about to bring it all crashing down. In a single weekend, a 158-year-old institution vanishes, triggering a global economic meltdown that costs millions their jobs, homes, and savings. How did one bank's failure ripple across the planet? And what secrets were hiding in Lehman's glittering towers? Stick with me, because this story of greed, risk, and betrayal will blow your mind. Lehman Brothers wasn't just any bank. It was a Wall Street titan born in 1850, surviving wars, depressions, and crises. By 2008, it was a powerhouse in investment banking, trading, and mortgage-backed securities. But beneath the shiny surface, trouble was brewing. See, Lehman was neck-deep in the subprime mortgage game. These were loans given to people who couldn't afford them, packaged into complex financial products and sold as safe investments. Sounds like a recipe for disaster, right? So, how did Lehman get so hooked on these risky bets? Let's rewind to the early 2000s. The housing market was booming. Home prices were skyrocketing, and everyone, banks, brokers, even your neighbor, was cashing in. Lehman saw dollar signs. They dove headfirst into subprime mortgages, bundling them into securities and selling them to investors worldwide. By 2007, they were handling billions in these deals. But here's the kicker. These mortgages were built on sand. Borrowers were defaulting, and the cracks were starting to show. Did Lehman know the risks? Or were they too blinded by profits to care? By 2007, warning signs were flashing. The housing bubble was deflating. Subprime borrowers couldn't pay their loans, and those safe securities? They were toxic. Lehman's balance sheet was stuffed with these bad bets. $85 billion worth, to be exact. Yet, their CEO, Dick Fuld, nicknamed the Gorilla for his aggressive style, kept pushing. He believed Lehman was untouchable. But was it? Or was Fuld steering the ship straight into an iceberg? Here's where it gets wild. Lehman wasn't just betting on mortgages. They were leveraging up to 30 times their capital. That means for every dollar they had, they borrowed $30 to gamble on these deals. It's like maxing out 30 credit cards to play the stock market. If it goes well, you're rich. If it tanks, you're done. And guess what? The market was about to tank. Hard. So, why didn't anyone stop this runaway train? By early 2008, the financial world was jittery. Bear Stearns, another Wall Street giant, collapsed in March, bailed out by JP Morgan and the Fed. Lehman's stock was sliding, and investors were whispering, "Is Lehman next?" Fuld tried to calm the markets, raising $6 billion in new capital and insisting everything was fine. But behind closed doors, Lehman was scrambling. They were hiding losses, using shady accounting tricks like Repo 105 to make their balance sheet look healthier. They'd borrow billions, move them off the books before reporting, then bring them back. Sketchy, right? How long could they keep up this charade? Let's pause for a second. Imagine you're an employee at Lehman in 2008. You're watching the news, seeing housing prices crash, and hearing rumors about your company. Would you stay loyal or start looking for the exit? Drop your thoughts in the comments. What would you have done? By September, the clock was ticking. Lehman's stock was in free fall, down 73% in a single week. Clients were pulling out, and lenders were saying, "Pay up." On September 10th, Lehman announced a $3.9 billion loss for the quarter. The market panicked. Fuld was desperate, calling every major bank, Barclays, Bank of America, for a lifeline. But no one wanted to touch Lehman's toxic assets. The Fed and Treasury, who'd saved Bear Stearns, were done bailing out banks. They decided to let Lehman fail to teach Wall Street a lesson. But at what cost? September 15th, 2008. The day the world changed. At 1:45 a.m., Lehman Brothers filed for bankruptcy. The largest in U.S. history, with $619 billion in debt. The news hit like a tsunami. Stock markets tanked worldwide. The Dow dropped 504 points in a single day. Banks froze lending, businesses couldn't borrow, and the global economy screeched to a halt. Millions lost jobs. Families lost homes. Retirement funds vanished. All because one bank bet too big and lost. Could this have been avoided? Let's break it down. Lehman's collapse wasn't just about bad mortgages. It was about a culture of greed. Wall Street's obsession with short-term profits blinded them to long-term risks. Executives like Gould earned millions in bonuses while pushing their firms to the edge. Regulators? They were asleep at the wheel, letting banks like Lehman run wild. And those complex financial products? They were so tangled, even experts didn't fully understand them. So, who's really to blame here? Lehman, the regulators, or the entire system? Here's a crazy twist. While Lehman was collapsing, its rival, Goldman Sachs, was betting against the same mortgage securities they were selling to clients. They made billions while the market burned. Meanwhile, Lehman's employees, thousands of them, walked out with cardboard boxes, their careers in ruins. The contrast is stark. The top dogs walked away rich, while regular workers paid the price. Does that sound fair to you? Let's zoom out. Lehman's fall was the spark that ignited the 2008 financial crisis. It exposed how interconnected the global economy was. When Lehman went down, it dragged everyone with it. Banks in London, pension funds in Tokyo, factories in Chicago. The US government stepped in with a $700 billion bailout for other banks. But the damage was done. Unemployment hit 10%, and the world entered the Great Recession. What lessons did we learn from this chaos? Hold up. Before we get to that, let's talk about Dick Gould. After Lehman's collapse, he became Wall Street's villain. He walked away with $300 million in compensation from his time at Lehman, while investors and employees lost everything. In 2010, he testified before Congress, claiming he had no recollection of key decisions. Really? The guy running the show didn't know what was happening? What do you think? Was Gould clueless, or was he dodging accountability? The aftermath was brutal. The 2008 crisis reshaped the world. Governments passed new regulations like Dodd-Frank to rein in Wall Street. Banks were forced to hold more capital to avoid another Lehman-style disaster. But here's the million-dollar question. Are we really safe from another crisis? Today, banks are bigger than ever. Complex financial products still exist. And Wall Street's hunger for profits hasn't gone away. Could history repeat itself? Let's wrap this up with some hard truths. Lehman Brothers' collapse wasn't just a corporate failure, it was a wake-up call. It showed how fragile our financial system can be when greed and risk run unchecked. It taught us that no company is too big to fail, but the fallout can be catastrophic. And it proved that the people at the top often walk away unscathed, while the rest of us pay the price. So, what's the takeaway? Stay sharp, question everything, and never assume the system has your back. Thanks for watching this deep dive into the fall of Lehman Brothers, the crash that shook the world. If you found this story wild, hit that like button and subscribe for more business breakdowns. Share your thoughts below. What do you remember from the 2008 crisis? And if you're hungry for more, check out our video on the rise and fall of Enron next. Until then, keep hustling.